So, guys, let's just get started. Welcome everyone for joining us today evening. We're going to be talking about something that everybody is really thinking about right now. What's going to be my tax bill for this year? And that's going to be one of the biggest check you're going to write this year, right? Because a lot of people pay so much money in taxes every year. So I thought it will be a great topic to talk about. And so we're going to talk about some of the strategic ways of how we wealthy people are able to minimize that tax, and that way you can see if that can fit your investments. So this educational session is mainly designed to help you understand how high income individuals legally reduce their tax liability through structured planning, real estate ownership, and long-term decision making. The goal is to provide more clarity and reduce the complexity, because the tax code is kind of complex for a simple person to understand. And that's why I'm going to try to break it down to make it more understandable. So the key points we'll be talking about is understanding how the tax system actually works, the difference between filing taxes and planning for taxes, because a lot of people think that my CPA is supposed to do the planning, but he's more on the filing side and really doesn't help a lot of people with their planning. Some of the ways how real estate can reduce the taxable income through depreciation, which you would have heard of probably. How the timing and the structure matters more than the income that a person makes. Some of the common mistakes that causes professionals to overpay on taxes, right? So we'll talk about some of those. Some of the long-term planning, protection for wealth that you should be doing to help you on long term, right? So there's some of the things we'll be talking about. Uh, so I'll just give a short introduction about what we do before we dive into all the details. I want to and why we are so passionate about helping professionals build real wealth through data-driven real estate strategies, right? So to begin with, first of all, my wife, Priyanka Shah, she has been with me in this real estate business for last 8 to 9 years now. And she has an IT background, wanted to get into business, and we have a business family background. So that kind of always feels like natural to us. So yeah, we started doing it. We started with flipping properties. Then over the time, we started doing rental properties, and then we started doing large multifamilies, and on and on and on. So that's how, even though we have an IT background, she's more of a project manager. She's helping me managing some of the business project management part of the business. So that's a little bit about her. And about myself, I've spent like over a decade working in capital markets, building models, evaluating risk, and helping investors grow their portfolios. Over the past several years, I've dedicated the experience towards creating structure and transparency and scalable investment opportunities for a lot of my friends, family, and people whom I'm able to convince them that invest with some of the real estate opportunities that they have. So that's all we have. Just to go over the compliances, this presentation is for education purpose only. I'm not a CPA, neither a tax advisor. I'm just providing some education information that you should reach out to your CPA and check with them if that applies to you or not. Any information provided is purely educational. Some of the investments that we recommend has some risk involved, so make sure you do your own research. Some investments that we provide is for only accredited investors, so you should make sure that you're qualified for that kind of investments. Performance past doesn't mean it will be in the future. So again, we need to be careful with that. And we are not making any offer. This presentation is for education purposes only. So just getting done with that, I'll get started with our topic. So as I mentioned, some of the key topics about this webinar is going to be more educational and strategy focused. We will discuss only legal and compliant tax strategies. We focus on long-term planning and not a short-term tactic or anything. So this is more for people who want to build wealth, not like quick fix, make a lot of money and not pay taxes. So we definitely believe in paying the taxes, right? But how to make it, minimize it legally. And some of the structures that real estate allows you to minimize your taxes, and some of the objective is to provide more clarity, right? So as we spoke about. Why this matters more than ever in 2026? Because the marginal tax rate comparison, you can see on the left-hand side, we've got W-2 earner, and the right side is more structure that a person can get to minimize the taxes, right? So tax rate remains significant at higher income level. People who make joint family makes $400,000, $500,000, they pay the highest amount of taxes because it's all W-2 earners and they are taxed the most. So those are the people who pay the most amount of taxes. And will their structured income can reduce the taxable income, but they are not aware about it, right? So that's where number one example is a W-2 income making $500,000, no major deduction beyond the standard deduction, federal tax, top margin bracket is 35, so effective will be 32%, right? Because how the more you make, the more taxes you pay. So total federal tax paid would be around $160,000. So after tax income, $340,000 after tax, right? So that's structure one. Structure two is more including real estate, getting some of the benefits of depreciation, things like that. So even if you have $100,000 income, if it's $250,000 W-2, $250,000 of real estate, your real estate income has some depreciation benefits. So let's say $120,000 of depreciation benefit, operating expense of 80,000. All in all, your real estate taxable income is going to be $250,000 minus 120,000 minus 80,000, 50,000 taxable income on that 250,000. So 250 plus 50, let's say total is around 300,000 taxable. So effective tax rate is going to be 24, and then the federal tax payable will be 120,000. So the same income, two people making the same amount of income pays way different in taxes and make a lot more money after tax, right? So that's what I want to really emphasize on, that the more money you make, you shouldn't be paying more taxes. You should be doing things so that you can minimize some of those taxes. Some of the core problems facing most professional is primarily they rely on W-2, right? So they lack any kind of ownership based structural assets. They focus on filing and not really planning, spending enough time. They will spend more time buying a car than they will spend planning their taxes, right? And that's how everybody does it. So I think they should be really understanding the tax codes and trying to understand, okay, how can I minimize my taxes? So yeah. So the big idea, taxes are shaped, not just calculated, right? So you need to structure the taxes. Tax liability is influenced by the decisions made long before the filing season. So now is the time to do things that can help you minimize your taxes when you get into the next year's for this year's filing. The system responds to more structure and ownership, not just income level. So you need to focus on that maximizing your income, but how do I structure it in a way? So structure, timing matters, and the ownership structure matters. So real estate touches all three of them, making it one of the few asset classes that can legally influence how income is treated, right? Because of the benefits it gets us. So, structure, timing, ownership, as I mentioned, right? How taxes really work. Some of the tax system actually works. So just a highlight, right? They don't simply tax income. It processes the income through a structured sequence. Understanding the sequence is where strategy advantage begins. So we need to make sure that we do the right structure. Income leads to classification. Based on classification, you get deductions. Based on deduction, you got taxable income, and that leads to tax owed. So income is the first categorized by type. Each category has a different rules. Deduction reduces with is considered taxable. So that helps you to get your tax income down, and only whatever is taxable is subject to the rates. So the structure determines how much income moves through the funnel. It's like a funnel that helps you reduce your tax. So taxes are not just about how much you earn, they are about how income moves through this system or the funnel and help you minimize taxes, right? So as I mentioned, income, classification, deduction, taxable income, tax owed. How different types of incomes are treated, right? So you got W2 income, you got business income, and you got real estate income. Not all income is taxed the same way. The structure of income determines flexibility, right? So how uh, and deductions and long-term impact, right? So those are the main things how it works. So if you look at W2, you don't get depreciation in W2. Business, there is some limited depreciation that you get. Real estate, you can get a full depreciation on the asset, right? Where you go is expense, uh, very limited expenses is basically standard deduction. Whereas business income, there is some deductions you can get, and there is expense offset. And for real estate, yeah, all the expenses are pretty much you can offset it. Timing wise, uh, there is nothing like timing. Flexibility, there is some flexibility, but there is a very high flexibility timing, how it works. So overall, as we can see, right, passive income block potential. So yeah, real estate, you can get the depreciation and then you can roll it forward and things like that. So there are some benefits with W2, but and business, it just depends. So that's why overall, I think business is definitely great if you can invest in a business, but real estate definitely provides a lot more benefits when you look at it that way, right? Understanding marginal tax impact. So as we mentioned, right, the first 50,000 you make, these just rough numbers, but just to get you an idea, first 50,000 is 12%. When you make the next 100,000, it's like 24%. When you make the next 200,000 is 32%, and then anything above 400 is like 35%. So that's how the tax bracket works. So the more you make, the more taxes, more percent of taxes you end up paying. So that's how the marginal tax works. Uh, and most people think taxes are handled in April, right? But that's not how it works. Filing taxes and planning taxes works differently. So generally, I would say January, you should start having a strategy. You should start making some decisions gradually, and then buy some assets, and then by December 31st, you're all figured out how your taxes gonna work out. So April is just for filing. Uh, that's how it should be done. So April reports the results, but January to December determines the results, right? So that's what you do during that 1 year is what makes the difference. Uh, so from January to April, the whole flow. Uh, when tax decisions are actually happening, uh, most tax advantages are created during the transaction, not during the tax preparation. So during the year, uh, Q1, you acquire asset income. Q2, you do income structuring. Q3, you do expense planning. So you need to figure out, okay, how can I maximize my expenses? And then Q4, you should be doing some final adjustments, right? So that's how it should be done over the year. So that way, by the end of the year, you kind of have a clear idea of how much taxes you will be owed by the end of the year. Yes, December 31st is the deadline, right? So make sure we get that all done. Uh, and so tax outcomes are decided at the moment of action, not at the moment of filing, right? So it should be all planned in advance. How real estate reduces tax liability, right? So one of the key principle is depreciation. That's the number one. Depreciation is the most powerful tool in real estate investing, right? So it allows us to uh, owners to deduct the cost of a building over time. Even if the property is generating income, you can still get the depreciation. So it's called like a paper loss. So depreciation is not a cash deduction; it's more a paper loss. It reduces taxable income just on paper, but in reality, you still make that money and you don't have to pay taxes. And then you can spend that money to improve your business, right? That's how IRS works. They want you to spend more money on your business so that it keeps growing. You buy one building, you make more money. You buy another building, and that's how the economy keeps booming. So that's how the taxes are written to maximize the growth of the economy. So you can receive income while reporting lower taxable income, and that way you don't have to pay that high amount of taxes. Uh, and just a simple example of how the depreciation works, right? A rental income, if you have $100,000 of rental income, if you have a $40,000 of operating expense, generally 40 to 50% of the expense is what is the standard, right? So we are taking that example. And then you have a $35,000 of depreciation. So the gross income, even though it's 100,000, you minus the expense, minus the depreciation. So taxable income is only 25,000, right? Even if your pocket, you're going to have $100,000, you'll be taxed only on 25,000. So actual cash flow is like 60,000, right? We have to pay the expenses, but taxable is only 25. So that's how you don't have to pay the taxes. And that's how the cash flow 60,000, taxable income 25,000, right? So the graph just shows us how much money we have at the end. And that's the beauty of depreciation. Bonus depreciation. That's an interesting way of getting depreciation even faster, right? So a large portion of eligible asset cost is depreciated in the early years instead of spreading across in 27.5 years equally. So that's the beauty of bonus depreciation. The way it's done is called cost segregation. So cost segregation is basically a strategy that separates component of a property into shorter depreciating categories, allowing investors to exit the deduction. And then there are some that are long term, like windows, carpets, things like that. They have a shorter depreciation. Let's say, for example, 5 years. So now you're able to depreciate it faster. Uh, so if you look at visually, this is how it works, right? Standard depreciation is a straight line divided by 27.5 years, whereas extra depreciation gives you that uh, the benefit upfront. So that way, more of your income could be offset with the depreciation. So you don't pay any taxes. You buy real estate for a few years before the depreciation is all gone. All right. But basically, that allows you to keep more money in your pocket, invest back, buy in the property, start getting depreciation, and just keep rolling. So cost segregation just front loads the tax savings into early years, improving early cash flow and reducing the initial tax burden, right? That's what we want. We want to defer taxes as much as possible, keep money in our pocket, and grow that. Just a simple example of $1.5 million property, right? Uh, Building a location is 1.2 out of 1.5. You say, okay, 300,000 is for the land. Annual depreciation without cost segregation would be 43,600, right? If you do cost segregation, around 40% gets reclassified in first 5 years, right? So that's how you can get accelerated. Extra depreciation is applied, and the first year depreciation would be around $350,000. So if an investor is in a high tax bracket, right, they are able to use this depreciation to offset that income that they made. So it drastically increases earlier tax efficiency, right? That's the goal. Uh, this is the graph that shows tax savings without cost segregation strategy is only 14,000. With cost segregation is 112,000. So that's the beauty of cost segregation. If you guys were not aware of it, it's something really helps, right? But there are some nuances to that. So we'll be talking about that. Uh, and so why after-tax returns matter more than gross return, right? So after-tax return is what is used to pay the taxes. So in a stock market, right? Let's say you get 10% return on a stock market, 32% tax on gains. So net after-tax return is, let's say, 6.8%, right? Because you have to pay 32% tax. Whereas in real estate, even if the 8% is your gross cash return, because of depreciation offset, taxable on the taxable income, after-tax return is only 8%. Uh, so so after tax return is 8% or even higher than that, depending on your income. So that clearly shows us that if you're making less on a real estate, it might be even better. It might be better even though it is lower than the stock market because of depreciation benefit that you're getting. So it basically lowers your gross return, can produce higher uh, tax wealth, right? The goal is to maximize our wealth. So that's just a graph here showing us how that works. Why real estate has structural tax advantages, right? So real estate is not favored by accident, right? The tax code is not made by accident. It provides specific structural benefits to maximize the economy. Uh, there are also other benefits such as 1031 exchange, which is a deferral opportunity. Basically, you can have a property and then you do 1031, you got the tax benefit. Now you can roll it over to the next property and continue uh, not paying taxes on any of that. So the step up basis, that's how it works. Even during inheritance, there is a benefit in real estate that you get a uh, so uh, if somebody passes away and you inherit a property, you don't the value of the property on the day you got it is what is taken, and you don't pay taxes on that benefit, the appreciation that happened before that. So for legacy purposes, also it's a great investment opportunity. Uh, it's a great passive income, right? When you talk about it, and all the tax advantages. So real estate aligns with the tax system in a way that traditional income does not, right? You make money, you pay taxes before you do anything here. You first pay all the expenses and then pay taxes on it. So that's how it really helps. We'll talk about some of the common mistakes that we have experienced while working with a lot of different investors, right? A lot of investors wait until the tax season, and basically now they think about, okay, what should I do now to minimize my taxes? My CPA is saying I'm going to pay 20,000, 30, 50, 40,000 tax, and I don't want to do that. But yeah, it might be too late by now. So how do we plan in advance is what we need to focus on. So most tax advantages are created during the year, right? Once 31st passes, there is not much flexibility left. There is some ways here and there you can do it, but that's very limited. Some of the strategic decisions must be happened before the year ends, so that you can get those benefits. And depreciation and all those benefits are available only if you buy the asset before 31st. And then that's it. December 31st locks the door. So make sure you start planning your this year now so that you don't pay large taxes. Uh, Next is the understanding passive loss limitation, right? So again, we said the depreciation that you get on your real estate. How can you get that depreciation onto a W-2 to minimize a W-2? So there is some limitation to that of how it works. So not all real estate losses can immediately offset other income, basically. So the IRS classifies most rental activity as passive. So passive income, passive losses can only offset passive losses. So W-2 losses can't be done. So rental income or loss uh, is a taxpayer real estate professional? That is the first question they ask. If you're a real estate professional, then there is some benefit doing that. So we're going to talk about what is a real estate professional. Uh, there are some passive losses that could be offset. Passive income could be offset by passive losses, as I mentioned. So that is there. But a lot of times there is very limited passive loss available. And otherwise the losses get carried forward next year, right? So that's how it works. So most rental income is considered passive, and passive losses generally offset passive income only, and unused losses carry forward, as I mentioned. So that way you're not able to take the benefit. So as I mentioned, yeah, losses may offset active income uh, if you're a real estate professional. So let's look into what a real estate professional status matter, why it is important. So if you see here, this is a nice chart here. You can see, okay, you have a rental property, you got losses and passive income, right? But it can't go over to a W-2. So then it carry forwards. Uh, but if you want to use loss against your W-2 income, you must qualify as a real estate professional. So if you want to qualify as a real estate professional, you need to put 750 hours plus a year to gain that status, which basically means you can't have a full-time W-2 job. You need to have a part-time or something like that to get this 750 hours. And you need to prove that real estate is your primary business. So you should be putting more hours in real estate than you're doing in your W-2 job, which is generally hard for a lot of people whose husband and wife both are on a W-2. One of you are not, then this is possible, because if you do joint filing, you can get that benefit. One person is a real estate professional, other one is W-2. that can be offset. Uh, and then, yeah, W2 is considered more active income. So salary, business income, other incomes are all considered W2 income. So makes it hard. So losses stay passive. You cannot offset W2. If you qualified as a real estate professional, you can offset your active income. So that's kind of a high level of how this real estate professional concept works. Uh, Going to the next topic, selling without planning any of your real estate can also have a significant capital gains. So we're going to look at a chart here, right? That a property was purchased for 800,000. Sorry, property purchased for 10,000. They were able to sell it for 1.2 with depreciation. Total gain 400. If they're taken the depreciation so far of 150,000, the capital gain tax is only on the gain, which is between 800 to 120. Sorry, between and the capital gain tax is 20% on the gain that you have made, which is on 400,000, which is $80,000. And then the depreciation recapture is actually at 25%. So it kind of comes and bites you back if you're not able to plan it efficiently, because all the depreciation that was given to you as a benefit comes back when you sell a property. So that is something that a lot of people are not aware of, that there is a depreciation recapture. So just getting the depreciation upfront benefits you, but then at the selling time, it hurts you. So that's why you need to plan it efficiently. Total estimated tax will be around 117,500 because you have to pay 25% on the depreciation recapture, which is $150,000, 25% of that, and then you pay 20% on the gain that you had from 800 to 1.2 million. So total, even if you made 400,000, you pay tax of 117. So net after tax, you're left with 282. So that's how it will work, right? So even though you make a lot of money, you feel most of the money is gone paying taxes. So you need to be very careful of how you sell. So what is a smart way of selling? So it's all about understanding the capital gain tax. When a property is sold, the profit is not simply retained, it is classified and taxed based on holding period and prior depreciation benefits, as I explained, right? So depreciation recapture is 25%. But again, if you sell a property in less than 365 days, you get tax at the ordinary income, which is generally between 35 to 37% for most people. And for the long-term capital gain is 15 to 20. So it's definitely helpful if you hold a property longer than 1 year, right? But a lot of times, if you don't do that, you're taxed at the highest tax bracket. So that's where the power of 1031 exchange comes into play. So here, 1031 exchange allows investors to defer capital gain taxes by reinvesting their proceeds into another qualifying property, right? So that's a great way of compounding your capital. If you don't need your capital now, you just keep investing. So in scenario one, if $1.3 million reinvested capital, right? And at 7% growth in 10 years, it's going to be 2.5. If you do 1031 exchange, and if you have annual growth of 7%, after 10 years, you will have 2.7 million, right? So there is a benefit of close to $200,000 by doing 1031 exchange. So that's really helpful in the long term building health, right? Because you're doing the same thing, but same growth projections, still you're making a lot more by the end of the period. So that's the beauty of 1031 exchange. Again, we can talk more in detail. If you have any questions, feel free to reach out, right? So long-term wealth strategy, what can be done? Many experienced investors do not focus on frequent selling. Instead, they build wealth through structured long-term ownership. So if you look at this visual, you buy, you get the depreciation benefits, then you refinance after a few years, you continue holding it, and then if you decide to give it to your son or somebody, when they get it, they don't have to pay any taxes on all the gains that you got it. They just get the property at the price the market is on that day, and from there they can get the benefit of that. So it's more like, that's why they say super wealthy people buy a lot of real estate. That's the reason, because it has one of the best tax benefits of holding real estate, right? So that's something I want to emphasize. Uh, if you look at some of the long-term wealth preservation strategy, right? So as we had mentioned, so wealth is not made in few years. It's take decades to build wealth. But yeah, we need to plan it that way. Short-term income is more creating comfort, but long-term structured ownership creates wealth. So that's where I like to educate people on focus on building wealth over long time, not short term. How can I maximize my return? Uh, and as you can see here, look at the chart here, right? Investor A, W2, right? Uh, Annual after-tax savings, let's say $80,000, invest 7% annually. 20 years, they will have $3.28 million. Same 80,000 deployed into leveraged real estate. Depreciation reduces tax drag, right? As we discussed, and they make 8% return on it, right? Uh, Sorry, 8% effective after tax growth, right? Because of the benefit of tax. In 20 years, that will result into 3.72 million. So that's like close to, after 20 years, it's close to $440,000 of advantage if it's invested in real estate. So that's why you need to be careful. You need to plan that in advance, right? And then you can see the gap between the two scenarios. Uh, Transferring wealth efficiently, as we discussed, right? True wealth planning, not only is it come today, but transfer efficiently across generations, right? Some of people are not thinking right now, but some of you might be thinking, okay? And that's where asset ownership comes in play, right? Understanding type of basis, as I had mentioned, that how the step up basis works, right? When you buy a property, when you pass it over, you don't pay any gains on all the inherited properties gains. So that's really helpful for your tax advantage. Designing tax outcomes intentionally, right? That's the whole conversation. How do we plan so that our tax is minimized, and so that's what we need to focus on. So, so again, tax efficiency can't be an accidental, right? It's through structured asset ownership and long-term planning. So if you look at this visual here, right, you create income, you do asset acquisition, right? From a W2, you buy real estate, you get depreciation, you get tax deferral because you are able to get those depreciation benefits, and then you do some wealth transfer. So income alone creates tax exposure, but asset creates structural flexibility that allows you to transfer wealth across generations. Uh, so there's no guesswork here. It's more designed through structure, right? So that's how you get wealthy. So this brings us pretty much to end of our presentation today. I'll just give you a quick summary of what we discussed today. The wealth equation, you need to understand income minus tax drag equals to retained uh, capital. And that's the power of compounding, right? So we need to maximize our tax drag. Basically, we are postponing the taxes. And as you can see, income only is a flat growth, but retained capital compounds faster, right? Because you have the capital, you deploy it and keep making more money. Uh, Structure changes the outcome, as we discussed, right? Whether it's real estate, W2, how you're able to maximize your tax efficiency. Uh, there's no structure. After tax income is lower, your real estate is much higher, right? Depreciation, there's no depreciation if you just make W2. So these are some of the benefits we discuss of real estate, right? Long-term growth is faster, and you can do generational wealth building, right? Uh, just to be clarifying, this is not legal planning or anything. We are just providing some advice, suggestions here, right? This discussion is about legal planning with the framework of tax code, right? So not tax evasion, not finding loophole exploitation, not aggressive or abusive schemes or anything. And it's one size fit all advice. It's not a one size fit all advice because, yeah, it might not work for you. So make sure you talk to your CPA or whoever your legal advisor is to make sure it is applicable to you. Okay. And yeah, so what this requires the tax efficiency does not happen automatically. It requires discipline and proper guidance, right? So make sure you get that from your legal advisor as we discussed. Uh, and just to give you a brief about value-based capital, what we focus on is we identify, acquire, and manage institutional grade real estate, which is without day-to-day headache of managing it, right? So these are some of the single-family projects we do. We do grounds-up redevelopment projects. So we do projects in Roselle Park, Linden, New Jersey. We do fix and flip projects. We have got two going on right now. We have multifamily projects where we have 6 unit, 18 units, and 66 units that we are working with. So we do a lot of that large multifamily projects. And then lastly, this is some of the referral, right? This is one of our old investors who've been investing with us for 7 to 8 years now since we started real estate, and they have great things to talk about us. We communicate and we are very transparent. We update them on what's going on, and they're very happy with the returns they're able to generate. With that, if you want to learn more about saving taxes, we have an ebook which you can scan this QR code to see if that applies to read the book, right? So feel free to do that. It's also available on our website. So if you go and find an ebook, you will have got a couple of ebooks there, which can really help you with some of your tax planning purposes. You can discuss with your CPA as well. This is the page where if you would like to set up a call with us, we are happy to discuss some of the ways you can minimize your taxes. So set up a one-on-one call. We have a newsletter that goes out every bi-weekly. So if you want to subscribe to that, feel free to scan it. And we also have an investor portal where we provide a lot of our articles and a lot of information to people who register on our portal. So feel free to register into that, so that way you are always the first one to get the information or any new updates that we have for you. With that being said, thank you very much for giving your valuable time. I hope this was helpful and was the great use of your time, and happy to help in whichever way I can. Thanks for everything, and hope you have great rest of your evening. Thank you, guys. Bye.